we can't get into a deflationary environment. It would be catastrophic for the Treasury. And they need inflation to continue to debase the dollar to pay down future debt with cheaper dollars. And that's just reality. It's called a soft default. We are mathematically set up to explode deficits and explode the debt to GDP. And so that brings us to the stock market, why it's all-time highs, why gold has ripped to all-time highs, why Bitcoin is chasing after it. These are the reasons that people are starting to get out of cash and out of bonds, and they're buying gold. If they do have a momentary lapse where they have a spike up in unemployment, but you have some sort of black swan event that causes something catastrophic in the banking industry or something in the financial industry, they will start QE immediately. Gold, stocks, Bitcoin, they're all going to continue to go up in value. But the reality is the dollar and whatever other currency you are based in is going down against it. That's all that's happening. And there's more of them chasing after the same finite number of assets.
This is The Real Story with Michelle Makori.
Hello, I'm Michelle Makori. You're watching The Real Story here on MFM. Thank you so much for joining us. The Federal Reserve has cut interest rates again, another quarter point as expected. But Fed Chair Jerome Powell is telling the markets not to assume that another cut is coming in December, saying it is not a foregone conclusion. Before he spoke, markets were pricing in a 90% chance of another cut. Now, the vote for this 25 basis point cut was 10-2. Governor Stephen Moran wanted a bigger 50 basis point cut. Governor Schmidt did not want a cut at all. So we had two ends of the spectrum, one calling for more easing, the other warning that the Fed has already gone too far. Meanwhile, the Fed also made a major policy shift. Starting December 1st, it is ending quantitative tightening. This means that the central bank will stop shrinking its balance sheet and stop the runoff of maturing treasuries. So the method used to drain liquidity will be stopped come December. Unemployment, the Fed said that job gains have slowed. Unemployment has edged up but remains low. And uncertainty about the outlook remains elevated. But the risk to inflation are tilted to the upside.
Today, the Federal Open Market Committee decided to lower our policy interest rate by a quarter percentage point. We also decided to conclude the reduction of our aggregate securities holdings as of December 1. Risks to inflation are tilted to the upside and risks to employment to the downside. A challenging situation. There is no risk-free path for policy as we navigate this tension between our employment and inflation goals. In the committee's discussions at this meeting, there were strongly differing views about how to proceed in December. A further reduction in the policy rate at the December meeting is not a foregone conclusion. Far from it. Policy is not on a preset course.
All right, so there is no risk-free path for policy. Essentially, the Fed is stuck between a rock and a hard place. Here to help us make sense of all of this, what it means for the markets, for policy, for gold, for Bitcoin, and more, is James Lavish. James is the managing partner of the Bitcoin Opportunity Fund, a macro-focused investment firm that bridges traditional finance and the emerging sound money landscape. And he's also the author of the Informationist newsletter. He's a former hedge fund manager as well, with over 2 decades of experience in risk management and market strategy. James, good to have you with us. Thank you so much for joining us.
Well, thank you for having me, Michelle. It's good to be here.
All right, James, as expected, the Fed cutting rates by 25 basis points. The Fed announced that it would be ending the reduction of its asset purchases, quantitative tightening on December 1st. So that means the Fed is going to stop shrinking its balance sheet. QT pulls money out of the system. They're going to stop that come December. Powell also said that a rate cut in December is far from a foregone conclusion. Now, James, you were expecting all of this, including the end of QT. You laid it out in your newsletter. So let's start off with your overall reaction to what we heard from Powell today.
Yeah, we heard most of what we expected. The one thing that I think the market didn't expect that he said was he reiterated a number of times, over half a dozen, maybe a full dozen times, that a cut in December is not a foregone conclusion. And he made sure that he made a point that there's kind of a split in the Fed body as to who wants cuts and who doesn't going forward. So this is kind of a grounds that we haven't tread on for a while. And why it's important is because the market has been expecting that we're going to get another 50 basis points through year end, including today's 25 basis points. So that meeting December, if you look at Fed funds futures before today's press conference, they were trading at 99% probability of a cut in December. And now, if you look at the futures, they're in the low 60s, and so there's quite a bit of a move. And I think a little bit of an overreaction. He didn't say that the cut is off the table. He just said, don't assume that it's there. So one of the things that he pointed to, and there's a lot to unpack here, Michelle. There's so much going on with the economy and the Fed. You've got kind of two economies going. He spoke to that, a K-shaped economy where you've got the very wealthy demographic is continuing to spend. They're driving the economy. They understand that. They know that. The stock market being at all-time highs is driving the economy as a backbone of that. And then you've got the lower demographic who's suffering. You're seeing a rise in defaults and 90-day delinquencies and credit cards and auto loans. And this is starting to become a problem for the lower demographic. And he understands that. So what did he point to for that December cut? Well, today he said it makes sense. We'll cut 25 basis points because of where we are. We've got inflation that's about 3%. And he reiterated they're going to try to drive that down to 2%. I don't believe that. I think that they're just comfortable with the 2 to 3% range. And so, which we'll talk about a little bit later about the debasement of the US dollar. But what he did say is that you've got an uncertainty in the job market. We're hearing about a lot of layoffs going on. It's unclear whether they're coming because of a true softening in the economy or whether it has to do with, like he said, supply demand and changes in the economy, participation rates and all of that. What is clear is that we've had a lot of jobs that have been revised lower. And so we had numbers that came out earlier this year that have been revised staggeringly lower. And so that's something that they're definitely taking notice to. But he's got two mandates. The Fed has a dual mandate, which is stable pricing, and that means a constant 2% inflation, and full employment. And whatever that is, there's no definition for that, but we're close to it. It's just that unemployment is rising. And so here you have an issue and they're in a tight position, and he knows it. They're in a really tight position here where we're entering something of stagflation. We've got an economy that's contracting, but you still have inflation. You're not having a decrease in prices. You're not running into a recession. You're running into a problem with the economy that you've got a K-shape, which is just a small demographic of about 10% of the people who are spending all the money. And then the lower 50% is really suffering. So he only has two levers. And one of those levers is interest rates. The second lever is QT/QE, which is expanding or contracting the Fed balance sheet. So why did he say that about December? He wants to keep that card in his pocket because now he's flying blind. And he literally said that. He said, look, we're not getting information from the government now. It's shut down, and we don't know when it's going to open back up. And we don't know how much information we're going to have before the next meeting. And so I'm not going to say that we're ready to, put another 25 basis points on the table. Everything's off the table. We're going to figure it out the closer we get to that meeting.
Right, and it makes sense that he wants to keep that card close to his vest, something that he could still play. He also doesn't want the markets to price that in definitively. That kind of takes away some of its impact. But what he did say was that they're going to stop quantitative tightening. So they're going to, instead of draining liquidity, they're going to stop that process. Now, you've written that you think that they'll actually move to quantitative easing. So help us understand what this means. Even if the Fed doesn't do QE, even if the Fed just stops quantitative tightening with this rate cut, I mean, that already adds more liquidity into the market and already increases inflation. Break that down for us.
So, okay, let's pull it all apart. So, what I was writing about a few weeks ago was that we're noticing that the bank reserves have dropped significantly in the last 2 months, and actually it's been the last like 3 to 5 weeks. And so they've dropped under $3 trillion. They're down at about $2.9 trillion. Why is that significant? It's significant because the Fed knows that they've got this level of bank reserves that they're comfortable with. And if they get below this level, then they go from being ample to not being ample. And so they're not quite as scarce, but it's just kind of a stop sign that we've gone through here, that it's something to take note of. And so what's the significance of that? Well, if you look back at 2019, we had a major repo crisis. What happened was we entered the September of 2019, and we had a few things that occurred that took bank reserves down rapidly. One of them was tax payments for corporations. Another one of them was an expansion of the needs of the Treasury. So their quarterly refunding was unexpected, the size of it. So that's the second thing. And then the third thing was just a need for dollars overseas. So we entered this period where in September you saw the overnight repo rate, where you take your treasuries. If you're a firm, an investment firm or a bank, and you take your treasuries and you need cash, you can loan them overnight in the repo and get cash for that and use your treasuries as collateral. Well, there was so few dollars out there and such a great need for dollars that the repo rate spiked over 8% in just overnight. It was absolutely insane. And so the Fed had to turn around, stop QT and start QE right away. And you could see it if you go look back at the Fed balance sheet. You can see that even before COVID, back in 2019, in that fall, you could see that their balance sheet started to tick up. You see this little hump in there. And then, of course, you see the $5 trillion print after that. But you could see they had already started it. And that was because of the repo crisis. So that brings us to today. Where are we? Well, back in 2019, those reserves were about 7% of the GDP at the time, right? So, and today, if you look at the bank reserves, they're running. So the Fed starts to get they start to get discomfort somewhere under 10 or 11%. They start feeling like, okay, we're getting to an area that's not fully ample, and so we've got to make sure that there's an ample supply of dollars out there. So that starts making them a little bit nervous. And then the second measure is, of course, the amount of reserves over the total bank assets. And so if you look back in 2019, those dropped to about 8%. So reserves over bank assets. And then as a share of GDP, it dropped to about 7%. So where are they today? Well, today they're about 12% as total assets, percentage of total assets, but they're back under 10% as a share of GDP. And so that's kind of it's a stop sign that we just went through, that, okay, now we've got to be aware of this. And so we're going to stop QT. We're going to stop draining bank reserves from trying to shrink the balance sheet of the Fed, and we're going to back off that. So when do they need to start expanding those reserves again? Well, he kind of alluded to that today when he was talking about it. He said, we don't know exactly when, but it's not until in the long distant future that we'll have to start expanding bank reserves again. It's just reality. It's just math. The question is, how quickly are they going to have to do it? The good thing for markets, and we shouldn't see a market shock from this, is that we now have something called the standing repo facility. That standing repo facility by the Fed means that major banks can use that for short-term liquidity needs, but it's not open to everybody. So we could still see a squeeze. You can see that rate tick up, which we have recently over the last number of weeks. We've seen that rate tick up to about almost 20 basis points higher than Fed funds. That means you're paying 20 basis points higher than Fed funds to borrow against what's supposed to be the pristine collateral of the world, the US Treasury. And so that makes them nervous. They're seeing these things and they're recognizing it. And so the QT is stopped. It's over for now. I don't expect it to come back for a while. And I do expect, like you said, that they're going to have to start expanding the bank reserves in due time.
All right, before we get more into that and inflation, because that was a very, very big theme of both the actual speech as well as the Q&A, before we get into that and where that leads us into the debasement trade, I want to talk about the job market, because Powell described it as cooling. Now, granted, we have missing data due to the government shutdown. Also granted that that data has been wrong more often than not with those drastic revisions, so not so sure how much difference it makes that we don't have that data. But he did say that, they're monitoring the shifts in the employment landscape very, very carefully. And that was following those recent layoffs at large U.S. companies who are actively implementing artificial intelligence, AI, and automation. We had over 100,000 layoffs in 1 week at a time that stocks are hitting all-time highs. We've got companies reporting record earnings, year-over-year growth rates are accelerating, and they had layoffs totaling over 100,000. UPS was leading with 48,000 layoffs, Amazon up to 30,000 positions, Intel reducing its workforce by 24,000 employees. The list goes on, as I say, about 100,000 employees being laid off, and not because of bad performance, because they can do without them. And this came up in the Q&A session. One of the mandates of the Fed is to, maintain the job market, but how can the Fed influence the job market with AI? Does the dual mandate get compromised here, James, if rate cuts are not really the right medicine, at least for that section of layoffs that are, fueled by AI? Powell himself said that AI investments, building data centers and automation infrastructure, is not especially interest rate sensitive. So if jobs are being lost to technology, not tight money, then you could say, James, that cutting rates isn't the right medicine here.
Yeah, I mean, we've seen this before, and that's why you see when you have a spike in jobless rates, in the unemployment rate, I mean, it spikes fast and hard. And that's why we enter what's called a recession, is that it's very difficult for the Fed to stop that. And so they're trying to do that. They're trying to head it off here by lowering rates ahead of any spike in the unemployment. The question is just how bad are these layoffs going to be? We've seen tens of thousands of people laid off, like you said, in the last few days by numerous companies. And so is that because of AI? Is it because they don't need middle management? Are they being replaced by certain AI systems? It's hard to tell right now. But what we do know is that the Fed data is flawed. And we've seen that for a very long time. We've had the revisions of almost 1 million jobs taken out from what was claimed from the last administration. They just weren't there. And part of the problem is that the BLS uses a calculation that has a model. It's called the birth-death model. And this birth-death model is not of people, it's of companies. And so they have these great assumptions that date back to different periods that may or may not even apply today. And so you're seeing them make assumptions about these creation and dissolutions of companies that are just flat wrong. And they've overstated them time after time after time. They've overstated the jobs created. And so it's difficult to see where those are. What's the tool they can use? Well, of course, there's what we call fiscal deficits, and they're using those best they can to continue to just pour money into people's hands and into the economy by issuing more and more and more and more debt. They're borrowing from the future to continue this engine roaring, and so nobody wants a recession, and so they're just going to continue to spend, and that's really the best way to keep the economy going in where we have it now. Is it right? No. Are we going to pay for it in the future? Absolutely. It's an engine that can't always go, and so we're mathematically set up to explode deficits and explode the debt to GDP, and so that brings us to the stock market, why it's all-time highs, why gold has ripped to all-time highs, why Bitcoin is chasing after it. These are the reasons that people are starting to get out of cash and out of bonds and they're buying gold. You're seeing central banks across the world buy gold because they don't want to hold treasuries like they did before for a number of reasons.
Well, we'll unpack that. But, to your point, the debt has now passed $38 trillion. Paying interest on the debt alone is bigger than the annual budget on defense spending, as we've discussed on this show many times. And then we've got inflation, which continues to rise. It was a big focus of the speech. Powell says it's eased significantly from its highs, but remains elevated. And according to the government's own reported inflation numbers, prices are up roughly 30% since 2020. So we do have a compilation of some of the inflation-related comments that we heard from Powell today.
We remain committed to supporting our maximum employment, bringing our inflation sustainably to our 2% goal, and keeping longer-term inflation expectations well anchored. I want to say, though, we're absolutely committed to returning inflation to 2%. If you look at longer-term surveys or market pricing, you will see that's a credible commitment, and there should be no question that that's where we're going. Most measures of longer-term expectations remain consistent with our 2% inflation goal. Inflation away from tariffs is actually not so far from our 2% goal. We estimate, people have different estimates of what that is, but it might be, 5 or 6 tenths, and so that if it's 2.8, then core PCE, not including tariffs, might be 2.3 or 2.4 in that range, something like that. So that's not so far from your goal. As I mentioned, non-tariff inflation is not so far from 2% now. Now, consumers are not interested in that story. Their prices are higher. More than that, the reason they're so unhappy about inflation is the inflation that we had in 2021, 2, and 3. Because, you can say that prices aren't going up as much, but that doesn't mean people aren't feeling those higher prices from the inflation we had 2 or 3 years ago. They are, and that's, I think, a large part of why the public, if you sample people, inflation is still very much making people quite unhappy. Even, and it's nice that, that prices are not going up as fast as they were, but they're still much higher than they were. And it'll take some time for that effect to wear off. As real incomes rise, it will feel better over time, but that's going to take time.
All right. So, James, this is the same man that told us inflation was going to be transitory. I will remind you of that. Now telling us that they're absolutely committed to that 2% target. And as he just acknowledged, since 2020, we have that cumulative inflation. Just because it eases doesn't mean it's been reduced. And that's, again, by conservative calculations, about 30% since 2020. So now we're cutting rates and stopping QT. What does that mean for inflation?
Yeah. Well, I mean, let's be clear. The Fed has the mandate, but the Treasury needs inflation. They need to have inflation to debase the dollar. They need to because we run massive deficits. And that's just a reality. We can't get into a deflationary environment. It would be catastrophic for the Treasury. Why is that? We have $38 trillion of debt today. Just last year, not even last year, just 10 months ago, a little over 10 months ago, we had $36 trillion of debt. So we're just piling debt on top of debt. So why do they need inflation? They need inflation to continue to debase the dollar to pay down future debt with cheaper dollars. And that's just reality. And that's called, it's called a soft default. So Powell keeps talking about 2%, 2%, 2%, but he understands, he knows that we need inflation of GDP in order to keep taxing cheaper dollars, to have more dollars to pay down debt in the future. Okay. So he also understands that this has created this since 2020, we have he said it himself today, the K-shaped economy, where you've got the very wealthy who are experiencing asset inflation and very easy outpacing their own consumer inflation. And then you've got the lower demographics who have not had asset inflation, who have actually had their pay, their wages not keep up with the inflation. So their real wages have gone have not kept up in a way that that they feel comfortable where the prices are. So like he said, yeah, the prices are up 25, 30% that they admit to. We know that healthcare prices or costs are up massively. Some people, it's more than doubled. Auto insurance has doubled. It's insane how some of these components have just gotten away from everybody. And so the lower demographic is really feeling it, because even if their wages do catch up, they've had years where it didn't keep up. And so it's been lagging. So what do they do when it lags? They borrow. They borrow on credit cards. They borrow. They don't pay down lines that they should be paying down that have high interest rates, and so they get themselves in a hole that it just is very, very difficult to get out of, and they're going to continue to feel this for a very long time, and that's really the big issue here. So, and he understands that, but the worst thing he can do is drive the economy into a recession, because it would only be worse for them, because a lot of lower demographic would lose jobs, number one, and then their wages would be gone. Forget about keeping up. And then on the backside of it, if you go into a recession, then the Treasury has a major problem financially. Like I said, $2 trillion deficits would blow up. Your expenses would blow up by 10%, and your receipts would go down by 10%. At the least. And if you have just a regular recession, it could go down 5 or 10%. So if they go down 10 or 20% or 10 or 20% up on your expenses, you're talking about $3-4 trillion deficits. And that would be a major problem for the Treasury. And that's something they want to avoid. So, Michelle, it's really simple. It's first principles. They want to avoid that pretty much at all costs. If they do have a momentary lapse where they have a spike up in unemployment, but you have some sort of black swan event that causes something catastrophic in the banking industry or something in the financial industry, they will start QE immediately. Now, I'm not calling for a black swan. It's just, you just never know when it's going. That's why they call it a black swan. You just don't know when it's going to happen. Neither do they. But they want to avoid sliding into a recession if they can and head it off at the pass. That's what you heard him say today. He cautioned, he said, no, don't get ahead of yourselves, but we're cutting rates today. We're stopping QT. We'll see where the information is in December, but we don't want to get ahead of ourselves either way. And that's kind of what he's saying.
And that leads to, as you said, debasement, right? Any which way you look at it, you're going to have more inflation and you're debasing the currency. And it now has a name on Wall Street. JPMorgan is officially calling this the debasement trade. That is one factor. And that is why we're seeing, gold and Bitcoin doing so well in this environment. So talk us through that.
Yeah. So JPMorgan came out. They came out with a report basically they sent out to their investors, and I'll read you exactly what he said, so then you can get a feel for what this means. They said the bank defines the debasement trade that reflects a combination of factors, which in our client conversations range from elevated geopolitical and policy uncertainty to uncertainty about the longer term inflation backdrop to concerns about debt debasement due to persistently high government deficits across major economies, to concerns about Fed independence, to waning confidence in fiat currencies in certain emerging markets in particular, and to a broader diversification away from the US dollar. Okay, so that's a lot to unpack. So we'll just unpack the most important parts of it that he talked about. He said elevated geopolitical and political uncertainty, policy uncertainty. We have no idea what governments are going to do next, and neither do they. We're experiencing it right now. We've had a government shutdown for weeks, and they won't talk to each other because one side wants to spend ridiculous amounts of money for social programs that aren't even here in the United States, or for people who aren't even citizens. And you've got the other side who says no. And so we don't even know what's happening there. We'll wait to see. Then another statement was uncertainty about the longer term inflation backdrop. We just talked about that. Inflation isn't going back to 2%. It's gonna stay above 2%, and they're just comfortable with that. They're trying to tell you that they're going to get it back to 2%, but that's not really the goal. The goal is to make sure that you think they're going to get it back to 2% and that 3% is okay. So they've got it more like in a range. Another thing they said is concerns about debt debasement to the persistently high government deficits. We already talked about that. Governments are going to continue to print money to make it easier to pay their debt, and that's not going to stop. They talked about concerns about Fed independence. Well, but the Fed's going to do what it needs to do to keep the Treasury solvent. The Treasury, their job is to do the Congress's bidding and make sure that they run the budgets that Congress hands to them, and they have to take out debt to do it. And the Fed makes sure that the Treasury doesn't blow up. That's basically what's going on here. On the flip side of it, they don't want the economy to blow up. That has a function to it too. Economy blows up, the Treasury blows up. So that's all kind of intertwined. Waning confidence in fiat currencies. We talk about this all the time. People are just realizing that their dollars and yen or their euros are losing purchasing power. This constant debasement, constant inflation is killing them. They can't just have money in the bank and sit there. They used to be, if you got a US dollar before 1971, you'd put it in the bank and it was okay. Not anymore. So, and then, obviously we've heard broader diversification away from the US dollar. You're seeing central banks buying gold instead of US treasuries right now. There's a reason for that. And it has to do with everything we just talked about. So you put it all together, a nice, neat little package, and it's called the debasement trade, which is own gold and own Bitcoin. You need to own hard assets.
Right. And, as you just mentioned, central banks are buying more gold. They own more gold now than they do U.S. treasuries. A lot of that had to do with the excessive weaponization of the dollar that came under the Biden administration, something you've discussed before, where, countries were concerned about holding U.S. dollar. The exorbitant privilege of being the reserve currency arguably was abused when they kicked Russia off the SWIFT system and confiscated U.S. treasuries. And we have seen this bifurcation of the global monetary system with the BRICS Plus shifting away from dollars and wanting to trade in their own currencies and buying gold as that neutral reserve asset. But what's so interesting to me, James, is you've got the major banks in Wall Street, not just JPMorgan, Morgan Stanley as well, saying you need to be 20% in gold, in alternative hard assets. You've got some of the biggest names in Wall Street, Ray Dalio, Jeff Goodluck, all saying that you need to get away from the dollar. And they're both saying gold and Bitcoin. And it's so interesting, James, because what happens on this show is when I say gold and Bitcoin, usually in the same sentence, the comment section lights up, right? A lot of our viewers do not like that I put gold and Bitcoin in the same sentence, although that is what a lot of the banks are saying, right? So we get the gold crowd bashing Bitcoin, and then we get the Bitcoin crowd dismissing gold as an old relic. Now, to me, they're both forms of sound money, just different evolutions of it. They're both anti-fiat. They're both decentralized. Now, I know, to me, if you've made a lot of money in Bitcoin, it makes sense to take some of that and buy physical gold, something that has been valuable for thousands of years. And if you're sitting heavy in gold, it just makes sense to have some Bitcoin exposure, to get off zero, as they say.
Yeah.
So, James, you own both. Explain to the gold people why Bitcoin deserves a place in their portfolio, and then to the Bitcoin people why gold still matters and deserves a place in their portfolio.
Yeah, I do own both because, full disclosure, I own way more Bitcoin as a percentage of my portfolio and my assets. I manage a portfolio of Bitcoin assets for my hedge fund. But look, gold and Bitcoin in the same sentence makes sense. And gold bugs should be pro Bitcoin and vice versa. Bitcoin to me is it's better. It's the ultimate asset, and it's ultimate because we're entering into a digital age. But why is Bitcoin trustworthy, and why should you have it in your portfolio? Well, first, it has absolute scarcity. Gold's the amount of gold moves up and down with the price. As price goes up, gold miners, they just ramp up productivity. And so there's a limit there. I'm not going to diminish that, but it's just not the same. gold is just going to continue to come out of the ground for the foreseeable future. We don't know how much. With Bitcoin, there's 21 million Bitcoin that are ever going to be made. Full stop. That's it. Period. That in 2035, there's going to be one left to mine. I mean, it's mind-boggling how there's no longer going to be full Bitcoin mined. So it's also portable and it's divisible. So try moving $1 billion of gold across the border. Nothing wrong with it, but you'd have to think about the logistics and costs required between security guards and trucks and boats and trains and planes or whatever you need to move all that gold to wherever it's got to be. With a Bitcoin, if you want to move $1 billion of Bitcoin, I could do it right now. If I had $1 billion, I could do it on the show in 10 minutes. By the time we're done, it would be done within 10 minutes and cost you just a few bucks. Bitcoin's unseizable. If you hold your own keys, then you can walk across any border and move anywhere around the world. As long as you have an internet connection, you have access to your Bitcoin. It can't just be seized at a border like gold or cash can. There's something called the network effect, Michelle, that most gold people don't understand and appreciate. And I didn't certainly appreciate it and understand it when I first got into Bitcoin. But Bitcoin, it uses the equivalent of 81 terawatt hours of energy, which is per year, which is the equivalent of over 20 full-scale nuclear reactors. That secures the network. That is what's securing the network of Bitcoin. So it's impenetrable. It's a fortress that it's nation state resistant. No state could just come in and say they want to change the code. It just can't happen. So they would be kicked off the network before they even got anywhere. So look, gold is time tested. It's institutional grade. Institutions have owned it and bought it. Central banks have owned and bought it for many years. It's bank approved, central bank approved, and it's really easy to understand. But Bitcoin is quickly gaining traction in Wall Street as a viable asset and collateral. And so that's something that we've seen that is developing real time. So now you've got JPMorgan, the same bank who is saying you've got to get in the debasement trade. They're putting together their structure so that by year end, if you're an institution, you're going to be able to borrow against your Bitcoin that you have with them. This is a massive, massive development that people are not talking about. It has to do with changes of legislation that occurred when Trump came in, that banks are no longer being sanctioned for dealing with crypto and Bitcoin companies. But now that you can take your Bitcoin and you can borrow against it in an institution, that this is where the institutionalization of Bitcoin is happening real time right in front of us. And so if you're somebody who owns gold, you really want to own some Bitcoin too. If I'm 100% wrong and you own a couple percent of Bitcoin, you're never going to miss it. But if I'm right, you're going to thank me because your portfolio is going to do far better than if you didn't have it.
All right, just some pushback. You do have the threat of quantum computing to the Bitcoin cryptography. Gold has stood the test of time. And we are seeing central banks around the world buy gold as part of the de-dollarization trend, as part of the bifurcation of the global monetary system. So again, I'm not going to get into a gold versus Bitcoin debate, but why would it make sense for people that have Bitcoin then to take some of their profits and put into gold, especially when you look at central banks, arguably the smartest money there is because they know what's going on, buying gold? Make the case why some Bitcoiners should own a little bit of gold and have physical custody of that. I always advocate for physical custody, be it Bitcoin or gold, and holding the asset yourself. But make the case why it would make sense for Bitcoiners to diversify into gold.
Well, if you look past the past few months, you would say that gold is nowhere near as volatile as Bitcoin. In fact, the volatility of Bitcoin has been lower than gold recently, which is just incredible. But over the course of time, very few periods in the history of Bitcoin, the life of Bitcoin, has gold been more volatile than Bitcoin. So one of the reasons you might want to hold gold is that if you have short-term needs that you want to keep your money invested in more than just a 4% yielding treasury, that you want to be able to get to it without the volatility of Bitcoin. Bitcoin's volatility may mean that you could see a 10, 20, 30% move in your asset in a very short period of time. But I can't make the case of gold over Bitcoin over a long period of time. So if you're older and you're retired and you want to be very careful with your money, and you just can't stand the volatility right now because you have short-term needs, it may not be right for you. It really depends on the individual. But if you're young and you've got a long timeline ahead of you, you've got a long runway ahead of you of investing, there's no reason for you to be, in my opinion, selling Bitcoin to have gold. But it's if you start getting worried about quantum computing, own both. That doesn't. I don't think there's anything wrong with that. Like I said, I personally own a whole lot more Bitcoin than gold, but I've owned them both for. I've owned gold for many years, and once I learned about Bitcoin, once I really truly understood it, it changed my view of where this world is going. One of the reasons you may want to own Bitcoin too is that you understand that the digitization of the whole economy, of AI and the onset of AI, is there's going to be a need for layers of payments that are on what are known as the blockchains, and Bitcoin is the most trustworthy of all of them. And there's a lot of different transactions that are being built on the second layer of Bitcoin. And that is another reason to own Bitcoin, because that network is just going to continue to grow and get stronger and stronger in the future. And as it does, then the price of Bitcoin, each Bitcoin, will just go up, and eventually it'll be $1 million per coin, and then $10 million per coin, and who knows from there. But that's my very strong opinion. I've been studying this stuff for a long time, and I'm extremely confident in the future of Bitcoin itself. So,
why do you think that there's so much hostility between the two camps, considering that we're both actually looking at a challenge to fiat currency?
well, I mean, with any kind of investment group, whether it's Mag Sevens or it's Bitcoin, you have something of a maximalist, where you've got people who are just entrenched in their belief of what is happening in their world. And so, when gold people hear about Bitcoin, they think it's not tangible. I can't touch it. I don't know. I just don't understand it. And there's a little bit of resistance there, and so. And I believe that creates some attacks, that Bitcoin's a Ponzi scheme, it's worth nothing, it has no underlying value on that side. And then from the other side, Bitcoiners just say, look, you're talking about a dumb rock that has some industrial use, and people use it for jewelry, but it's not good money. Bitcoin's far better money than gold is, and so you have that argument. So, it's just an entrenchment of viewpoint, and really a lack of understanding about Bitcoin. And then Bitcoiners just, of course, being very aggressive. They're younger, typically. They're passionate, super passionate, and sometimes they can get out of bounds. I agree and admit, but it's a matter of opinion. I typically don't attack gold holders. Like I said, I own it myself, and we're both fighting for the same thing. That's the crazy part, is when you hear a gold bug talk about, or somebody who is very passionate about gold and has owned it for a long time, what do they talk about? They talk about deficits. They talk about fiat debasement. They talk about the need for hard assets, hard money. It's the same thing that we talk about. It's just it's digital in nature. It's really the same exact thing, except it's kind of it's a digital form, and it's an upgrade on in the aspects that I talked about.
Right. And gold does have that track record of being money, of being a store of value for thousands and thousands of years. So it certainly, definitely has that over Bitcoin. I hear your point that Bitcoin has more appreciation potential. Although, granted, there are some out there that think that gold could be revalued and could have a dramatic jump in valuation as well, perhaps not as dramatic as Bitcoin. But back to the idea of the debasement trade, this is the theme. We heard from Powell, they're going to cut rates. That means more printing, quantitative tightening, more liquidity, potentially quantitative easing again. It's all this liquidity, it's all this debasement, and it ultimately leads to gold and Bitcoin, or gold and Bitcoin. And again, this is what the biggest banks in Wall Street are now saying. I want to get some of your price forecasts here, James, because what do you, and we won't go like 10 years out, not yet, but where do you see gold, which has had a bit of a pullback right now, many would say a buying opportunity, where do you see gold next year?
Well, I mean, if you just take it on first principles that we're going to continue to have debasement of currency, continue to have expansion of not just the money supply, but liquidity around the world. So we're just so leveraged in the financial system across the world that we've got to continue with this leverage. We know that. So there's an expansion of liquidity. And so I'm watching that expansion of liquidity, and it's continuing. I think it's going to continue into next year. You heard Powell say they're stopping QT. That means that at some point in the near future, that is going to flip to QE at some point. We don't know when, but I believe that we're just going to continue to see expansion of liquidity into next year. So that means to me that gold can still, it's not done yet, in my opinion, and it could still rise. And whether it gets to 5,000 or just around there, I mean, that would not surprise me at all. As far as Bitcoin's concerned, I fully expect Bitcoin to run to 150 to 180,000 toward the end of this year and into the beginning of next year, and probably into the 200 range. We typically see an exuberance and blow off top with Bitcoin that may be muted this time because we have so many institutions that are involved now. So the volatility may be dampened for this liquidity cycle. There used to be there has been what people talk about, the 4-year halving cycle of Bitcoin. And Bitcoin typically has a blow off top where it just gets way ahead of itself and over exuberance. And after the halving, and then it has a drawdown, 60, 70, 80% drawdown. I don't see that happening this time. I do see it having a drawdown after its blow off top, but I think it's going to be different because of the nature of it now moving into it's much more correlated to the expansion of liquidity, and not just money supply, but the expansion of liquidity around the world, around the whole world, not just the US either. And I think that's going to continue. The liquidity is going to continue to expand into next year. We will have a contraction at some point. How big, we don't know. But we also know that on the backside of that, central banks will print again, and it all starts all over again.
James, we've had guests on the show, including Judy Shelton, who think that the U.S. may issue some kind of gold-linked, gold-backed treasury. We've had guests on the show that believe that the U.S. will somehow anchor itself to Bitcoin. What are your thoughts on both of those ideas?
Well, I wouldn't be surprised at all if the U.S. government did something around gold, but whether or not they revalue it, that's up for much debate. And I do not have enough knowledge around that idea to speak intelligently about it. But I could talk about the idea of Bitcoin being part of the U.S. government. I've met and talked with Cynthia Lummis, the senator from Wyoming, who created a bill called the Bitcoin Act. And that act is it's for the U.S. government to buy 1 million Bitcoin, which is 5% of the supply, 200,000 Bitcoin every year for 5 years and put it on the balance sheet. But why would we want to do that? We would want to do that because as Bitcoin appreciates in value, meaning there's two reasons that Bitcoin appreciates in value. Number one, because of the expansion of liquidity and the expansion of the money supply, more dollars and more fiat currencies chasing after a finite asset. That's number one. Number two is it takes market share from other assets that those same dollars are chasing, whether that's from gold or whether it's from stocks, whether it's from bonds or real estate. It draws from those as people realize this is a really easy asset to park my money in and make sure that I'm protected against that great devaluation. Okay, so as that happens and Bitcoin rises in value, then over the course of the next 5, 10, 12 years, the US government own an asset that would appreciate tremendously. So if you have 1 million Bitcoin and Bitcoin goes to $1 million, just think about how much the US government could use to pay down their debt. Where the debt is at that point, 10 years from now, it's going to be over $50 trillion easily. It's going to it doubles about every 10 years. So it's going to be, somewhere around 75 or 80 trillion dollars in 10 years. With Bitcoin appreciates against that. Well, the idea is that you could take some of that Bitcoin and put it on your balance sheet and strengthen your balance sheet, strengthen the Treasury's balance sheet so that they can still issue treasuries without the worry of they're just going to have to someday default altogether. Well, if they have Bitcoin in the balance sheet, it strengthens it. They could either pay down debt or they can use it just as a strong collateral against it.
Well, I mean, you could make the argument then why not just buy Bitcoin? You print dollars. The U.S. government could just go ahead and buy Bitcoin at will.
That's a good idea.
Doesn't need to wait for anything. But then, when you look at what the other central banks in the world are doing, they're buying gold. Very few have Bitcoin. There has been some trend to add Bitcoin to the balance sheet.
Yeah, that we know of. Then look, the ones who are buying gold, your listeners, and they know this all too well. They're doing it very quietly. And some central banks are doing it through Swiss banks in a way that it's not being shown. Okay. And so we don't know exactly how much gold China owns or Russia. We don't know exactly how much these countries are buying, the BRICS countries in particular. They're trying to get away from the Treasury because they're trying to get away from the US dollar. I don't believe they're going to come up with their own currency. That just doesn't make sense to me. Not with the type of leaderships they have. I don't see them coming to an agreement on what kind of currency they could have. But I do see them coming to an agreement with a non-partial asset like gold or Bitcoin that they can use in transactions. That makes sense. Something that's not dollar linked. But they could be buying Bitcoin quietly and nobody would know. If you're a central bank, why would you announce that? You would be quietly buying it in exchanges and putting it in a wallet that they don't know about. Eventually, people will figure it out because Bitcoin is completely transparent. You can see every single transaction on the time chain since the beginning of Bitcoin in 2009. So it can't stay quiet forever. But in the beginning, as they accumulate, sure it can. And so we don't know. Do I expect a large central bank is buying it right now? I don't think it's happening yet, but I do expect smaller central banks are doing it. And, whether or not the US is doing it, who knows? I don't think they are right now. But as this bill goes into Congress, snakes its way through Congress. It has already, Cynthia has gotten a couple of co-sponsors on it, and it's going to have to go through the gauntlet of legislation. And I do believe it does pass eventually in the next few years while Trump's in office. What it looks like at the end of that, probably a little bit different than it does today. But yeah, that's the case for both of them.
Well, we do have a very Bitcoin-friendly administration. So you believe that this bill would be passed within the next 3 years under the current Trump administration?
Well, I mean, everything moves at glacial speed in Congress, but there is a push from a small group of people that really want this to get done. If it doesn't get done in this administration, assuming that that we have another friendly administration in the next one, then I do think it happens. I think it happens sooner than people think.
Well, correct me if I'm wrong, Senator Lummis wants to sell the gold and buy Bitcoin. Do you think that is going to happen?
Well, I don't see that happening right away. But they have said they want it to be budget neutral. So whatever they do, they don't want to be, like you said, printing dollars to buy the Bitcoin. They want to make sure that they're not creating larger deficits from it. So where that money comes from, it's uncertain. But there's plenty of places they can find it at this point. You saw what Doge was doing. There's a lot of excess in our spending.
There's a lot of excess, but there's fiscal dominance. No one is able to cut anything. Hence, we have $38 trillion in debt.
Yeah. And that's the problem. And that's exactly why you need these hard currencies. You need the hard assets. And that's the whole debasement trade right there. And it comes full circle. They're not going to stop printing. They're not going to stop spending. They're going to continue debasing. And that's why we own them.
Do you see a monetary system with both gold and Bitcoin as reserve assets or as some underlying layer?
Well, I don't see us selling our gold anytime soon. So it would be, it's technically already a reserve asset. So, but what I do see is us adding Bitcoin to the balance sheet. And I do see
well,
that
we already have that. We have
a little bit. Yeah, a little bit, but not really enough yet. But if we add it in earnest, that's going to become a major piece of the balance sheet. And that will, in my opinion, that will happen in the next 5 or 10 years. We will be doing that.
Again, I think it's only relevant if other central banks are doing that. I know you believe that they're doing that secretly, but you can't deny that Bitcoin has now become entrenched into the financial system at large in ways we wouldn't even dream, possible 4 years ago. As you say, Bitcoin being used as collateral in banks. We've also got these Bitcoin Treasury companies. Explain what that is, why we are seeing that trend, and how that links to, again, debasement and people losing faith in dollars and not wanting to save their money in any kind of fiat.
Yeah. So first, before we talk about that, the central banks buying them, it's kind of a game theory. If you know that if the U.S. is buying Bitcoin, or you think they are, then you're Russia or you're China or you're India. What do you think you need to be buying Bitcoin to? It becomes game theory where if you don't buy some, you're left out. And so you need some too. And so that's kind of that is the theory there. And that's the approach there. But so Bitcoin Treasury companies. Yeah. So what some of these companies have figured out, like MicroStrategy, now called Strategy through Michael Saylor, what they've figured out is that there's a way to arbitrage the capital markets, to be borrowing dollars, to be buying Bitcoin, an asset that's rapidly appreciating. And so if you can do that, then you can create a balance sheet fortress that you can borrow against and continue to add Bitcoin to it. As an investor, what you're investing in those companies, you're investing in that strategy of being able to accumulate Bitcoin by borrowing dollars. It'd be like you going out and getting a personal line of credit. You go to Wells Fargo, you get your personal line of credit, and then you go and you buy Bitcoin with that line of credit. As long as you have either enough assets or enough income being generated elsewhere, or Bitcoin appreciates to a certain value, you can continue to pay the interest on that loan indefinitely. And so that's the idea, is that you continue to accumulate Bitcoin by borrowing against it. And as Bitcoin accumulates, you can borrow more. And then you're able to keep you're able to keep that leverage ratio low enough that you won't ever trip that. You won't ever be in a position where you have to sell Bitcoin in order to pay down a loan. As long as you can keep that going, then that's the strategy. And Michael Saylor has done it brilliantly over at MicroStrategy, and you've seen his company become one of the largest companies in the world by accumulating Bitcoin. Well, he did that because he's got the ability to add this highly volatile and rapidly appreciating asset to his balance sheet, and then borrow against it in order to buy more. And he first monetized volatility, and now he's monetizing that. He's basically arbitraging capital markets by being able to borrow a depreciating currency to borrow more, to buy more of this hard asset and put it on his balance sheet. And so now you've got a number of other companies that are doing that. You've got CEP21, which is Jack Mallers from Strike. He teamed up with Cantor Fitzgerald and Tether, and they're doing it. You've got the company that I'm involved in, Strive, which is Strive Asset Management. Those two companies merged, and I can't say too much about it, but I'm a director in that company now, and we're in the middle of a merger. We're buying Semler Scientific, who is another Bitcoin Treasury company. But there's a number of these out there that they're filling holes. Like there's one MetaPlanet, which is out in Japan, and that filled a need for investors in Japan to be able to buy a Bitcoin through a publicly traded vehicle, which they weren't able to before. And so now they're able to do that, and that company has exploded in value because they're able to do the same sorts of things. So it's an exciting space. It got kind of ahead of itself before this summer. There's a lot of different players involved, and some are better than others. And again, I can't speak individually about companies, and because I'm either both involved in them or we're invested in them, but they're not all created equal. You have to have strong management. You have to have a strong strategy around it. You have to have a strong balance sheet and the ability to interact with capital markets in a way that they can trust you and they can trust your balance sheet. And some of the companies can do that better than others. And so I do believe there will continue to be consolidation in this, but there's a long runway for these companies. And that runway has to do with just the sheer amount of different types of investment instruments that could be out there that are built around Bitcoin, just like there are ones that are built around the US dollar. And they're anywhere from preferreds and converts and debt-based instruments that there can be thousands and thousands of them. And no one company is going to do all of them. There's going to be a need for many of them.
Well, it brings up a couple of points, James. One, if you have a Bitcoin treasury company that's over leveraged, that is not well managed, that could potentially create a lot of price volatility with the underlying asset with Bitcoin that could translate to the Bitcoin price at large. And then you have the bigger idea, which the theory is that Satoshi Nakamoto created Bitcoin after the 2008 financial crisis to move away from the traditional financial system as an alternative to all of this. So when we're developing derivatives against Bitcoin, and we have ways to manipulate Bitcoin, and we're bringing it into the traditional financial system that Bitcoin was supposed to be a way out of, doesn't that sort of compromise the initial ethos of Bitcoin to be decentralized, to be independent? If it's so woven into Wall Street right now, there's risk of, contagion should something happen. And there's this bigger picture argument that this is contrary to what Bitcoin was supposed to be. And then we know that there's manipulation, unfortunately, in the precious metals market with, paper silver, ETFs, derivatives. Doesn't this now make it more likely that you could have paper Bitcoin and the price of Bitcoin being manipulated? I mean, bottom line, is this not contrary to what Bitcoin was supposed to be?
Well, there's no doubt that it's different than maybe the early inventors, Satoshi and his little circle there.
Assuming you subscribe to that theory, but okay, we'll take that as an assumption point.
Yeah, assuming that that's what they wanted is truly sovereign money. Yeah, but if you think about it, there was really no other way for this to happen. If individuals are going to be involved, then institutions are going to be involved. Why are they going to be involved? Because the individuals who those institutions are representing are demanding they get involved. If you have a pension fund that you've got many participants in the pension, they may want to be involved in that. Or you've got liabilities that you've got to meet in the long term, and that you've got to be out there a little bit on the curve to make sure that you're able to protect their purchasing power in the future for those liabilities that you have. So that's one thing. And then it as Bitcoin becomes more and more understood and much better understood, Michelle, I think that it's a natural process that you're not going to have the volatility that you did. It's just right now, it's the nature of an asset. It's a nascent asset that's being adopted, and that rapid adoption has created massive volatility. But I expect as more and more institutions get involved, it will dampen that volatility. And is look, it's like anything that you have, the housing market, or we've seen it. You've got the CRE market. Could that produce contagion for regional banks? Somewhat, maybe, but these Bitcoin companies are having to create these products that have enough coverage that it won't be a problem. Do I think there's going to be contagion and a big wipeout across the industry? No. Do I think there are going to be some that get themselves over their skis and they do get wiped out? Sure. It happens in every kind of industry. But that wouldn't surprise me at all. But they'll just be gobbled up because they have great amount of Bitcoin on their balance sheet that would be attractive to another company that would make it accretive to buy them. So those are definitely some short-term and small risks, but I don't see that as being a major catalyst risk. I do think that it's a natural progression and evolution of Bitcoin to become part of the institutional investment landscape and the financial industry. This is kind of the way it's going to have to grow into. And as it does that, I think that volatility dampens quite a bit.
But are you concerned that it makes it more prime for manipulation, again, with this idea of there being, paper Bitcoin, ETFs, derivatives, easier to manipulate the market?
Well, it's different than gold. If you have an ETF
or futures contracts, forget the ETFs, just like futures contracts,
Sure.
Paper representation in various forms does make the underlying asset more subject to manipulation, one could argue.
You could argue that, but you could also argue that it just dampens volatility because you have all the ability to trade around it on both sides without the physical. And so that's one thing. But the other thing is that the Bitcoin ETFs, or the reason they're different than gold ETFs is that there's a few things here, Michelle. Number one, Bitcoin ETFs, the spot ETFs, have to own the underlying Bitcoin that is commensurate with their NAV. Okay, so they have to physically go buy this Bitcoin and hold it in storage in what's known as either cold storage or on exchange. Okay, so you can very easily verify in an audit whether they have those just by looking at the addresses of the Bitcoin. So you can't do that with gold. We've seen problems with gold where an ETF says they own it or whatever, or a bank says they own it and it's not there. We saw it with JPMorgan where they thought they had gold and they had $50 million worth of gold-plated nickel. It's just the nature of that physical commodity. So that's, again, it's nothing against Bitcoin or gold ETFs. It's just a difference there. The second thing is we just had something passed by the SEC, a small little ruling passed by the SEC where if you're an institution, you could send your Bitcoin to a BlackRock, and you can have it create an ETF for you out of that in-kind exchange, and avoid taxes, and then use it as collateral on your balance sheet in the financial system rather than having it outside the system, which is very difficult to use for collateral. So that also will dampen the volatility because you won't have Bitcoin sold in order to do things they want to do. They can just use it as collateral and, again, borrow against it on margin like anything else. And so these are developments, and this is the way that Bitcoin is maturing. And so put it this way, I'm more optimistic about that than I am worried about manipulation through the paper markets. That doesn't worry me.
Okay, well, I'm going to change direction to something that potentially worries me. Something that definitely worries me is a CBDC, a central bank digital currency, and I'm going to link it to the Genius Act, as you did in one of the pieces that you wrote on The Informationist, which again, I cannot recommend enough. Everyone should subscribe. It's a great read, breaks everything down in a simple, digestible pleasure to sort of consume. But so let's talk about the Genius Act here, because one of the ways that the US government is trying to tackle this $38 trillion in debt is to create, and the de-dollarization trend, is to create more demand for short-term debt through the creation of the Genius Act, which essentially regulates stablecoins. It stands for the Guiding and Establishing National Innovation for US Stablecoins. And it establishes the legal framework for payment stablecoins, which are digital tokens pegged one-to-one to the US dollar, fully backed by cash and short-term treasuries. And you need these stablecoins when you are transacting in the crypto universe. So we've had the Genius Act passed. Critics say that that may be a stealth gateway to a CBDC. When the Genius Act was passed, one of the consoling factors was that the anti-CBDC bill was also being drafted in Congress at the same time, something that would explicitly block the Fed from issuing a central bank digital currency. That anti-CBDC bill still has not been voted on. No progress there, as far as I know. Meanwhile, the Genius Act, as we know, is already into law. So before we get into those implications, maybe help us understand what the Genius Act is, what stablecoins are, and why this could potentially be a backdoor for a CBDC.
Yeah. So first of all, what is a stablecoin? Well, a stablecoin is basically it's a cryptocurrency that's pegged to something, right? So you can be pegged to anything. You can have it pegged to gold. You can have it pegged to yen or euros. But by and large, almost all of them are pegged to the U.S. dollar. People want U.S. dollars. It's because it's the cleanest shirt in the dirty laundry, right? So, but why is it important? Why do people why do they want this stable coin? Well, it used to be that when you took your money and you put it on exchange, you would put it on exchange and just have to go buy something on one of these crypto exchanges. And so people wanted to be able to buy and sell a Bitcoin or an ETH or something, and they wanted to have their cash ready to be able to do that really quickly. And the best way to do that was to have it paired with another cryptocurrency. Well, the cryptocurrency ended up being these stable coins. And so the stable coin is pegged to the currency. It's pegged to the US dollar. And so what they do is those stable coins will take those dollars that you send to the exchange. They'll buy the stable coin. The stable coin issuer will take those dollars and they'll go buy something that is denominated in US dollars, just like a money market would. Well, what are they going to buy? They're going to buy treasuries. Typically going to buy T-bills, lots of T-bills. And that's how it kind of evolved, where now you send your money to a Gemini, or you send it to like a Coinbase or a Kraken or whatever, and you want to have your money ready to buy some of these cryptocurrencies. Well, it's not going to just sit there in dollars. You're likely going to buy one of these stable coins instead. Okay, so what's important about the stablecoin, and why would we have the Genius Act? Well, about a year and a half ago, I went up to DC to help educate some of the representatives in Congress and their staff on just exactly what Bitcoin and stablecoins, all that are. Turns out that they were well aware what a stablecoin is. A little bit confused on the Bitcoin side, but we weathered some of that. We're getting a little bit closer. But the stablecoins, they realized very quickly that it's really important. Why is it really important? Well, what did I just say? It was a way for people who wanted to be buying these and getting their money on exchanges to trade in cryptocurrencies to sit in U.S. dollars. Well, then you had what was known as the biggest issuer of stable coins is Tether, and Tether, as over the course of the last number of years, has grown to become a top 10 buyer of U.S. Treasuries. That they're so big now that the U.S. government recognized, oh wait, these guys are, and that's not just U.S. citizens buying this. This is people from all over the world who have just a phone and they log on to their exchange. They take their currency, whatever it may be, whether it's a yen or it's a euro or it's a real, whatever it may be, and they go and they turn it into U.S. dollars and buy Tether. And so now Tether turns around and buys treasuries. So we've got this person who is at far reaches outside of the United States, who's not even in the banking system, may not even have a bank account, but somehow has gotten access to an exchange on their phone, and they're able to buy U.S. treasuries. Mind blowing. And so they thought, wow, we really need to get some sort of legislation around this so we can understand it better and make sure that it's operating properly, because this is a pretty good thing. So what's the Genius Act? So the Genius Act finds its way into Congress, and it ends up getting passed. And what it is there's legislation around it. There's rules about how these will work and how they need to be, there's licenses that are going to go to the big banks, the JPMorgan Chases, the Citigroups, the Wells Fargo's, whoever it is, and they have to have a very large circulation of dollars. And then the stable coins that they issue are going to have to be backed by the U.S. treasuries or cash. They're going to have to be highly liquid, and they're going to be audited. They're going to be audited, mandatory, regular audits that show that you own exactly what you say you own. And then on the side of that, an important part of it was the people, the representatives who were pushing this and understood it, listened to their constituents, said, we got to be careful that these don't turn into CBDC. So we've got to have an anti-CBDC rider on the side of it. Okay. The Genius Act passes because, of course, we know that we need as many buyers of U.S. treasuries as we possibly can. We're going to find every single hole in the world that we could possibly find to buy more treasuries, and we're going to do it through these stable coins. Okay, so then this passes, the Genius Act passes, and then the anti-CBDC rider just kind of gets sent to the House, and it's just sitting there, and nothing's happened with it. So why would that happen? Well, part of it is that they're kind of distracted right now, right? So they're focused on and I apologize. I said the House. It got to the Senate. The Genius Act passed and it's now in law, but the anti-CBDC Act got sent to the Senate and stuck there. So what needs to happen? Well, they're focused on the stable coins right now, and they're focused on helping kind of craft how these are being created with the Treasury. And that's one thing. So that committee is kind of focused on that, I believe. And then the second thing is it's just they're right now they're fighting over whether or not we're even going to have the government's going to open again. So they're completely distracted. Do I think it's dead? No. Do I think it's going to find its way through? Yes. It's just going to take some time and maybe some motivation from somebody who is really interested. But we'll see when that happens. I'm not too worried that it's not going to happen, but I am very concerned as you are, that CBDCs are not something that we want.
Well, we definitely don't want them, because that's an Orwellian future where every transaction is monitored. It's programmable money. The government can decide when you can spend your money, on what you can spend your money on. You link that to a digital ID and a social credit system. And yeah, we have an Orwellian dystopian future. But one of the concerns here, and I get that you're optimistic that it's just sort of fallen into the background with all of the dysfunction happening in Washington, D.C. But, what we do have with this Genius Act, with stablecoins, it's essentially programmable money. It's surveillance-ready digital infrastructure. And it's a multi-trillion-dollar ecosystem of what they call narrow money, which is digital cash that does not, circulate through the traditional banking system, but lives on a chain as tokenized treasuries. And that is why the critics say that this could usher in that CBDC. So how confident are you that this doesn't lay that groundwork, that even if we do get an anti-CBDC, bill passed, that this doesn't already establish the infrastructure?
Well, I mean, look, I'm wary of it because of what we're seeing. We've seen it in China. If you stand next to the wrong person in China that doesn't have a high enough social score, you literally receive a notice on your phone that says you need to move away from this person, and especially if you're associated with them, because your accounts can be shut off and you're not going to be able to buy goods. And so then they're trying to push them right now in Europe, or actually not even trying. They're ramrodding them through in Europe, and in the name of immigration control, which is just, they're having everybody have a citizen ID, like a digital ID, and that's the start of the digital currency, and it's insane. So I am very wary of it, and it concerns me. And we have a lot of people in Washington who are fighting against it, making sure they understand that the citizens don't want this. Well, it could. It's possible for these things to be turned into CBDCs, but if we have the legislation around it that is anti-CBDC, then there's not an incentive for the banks to do that. The banks are incentivized to make money and create these things, make them available to you to make money off of. One of the key aspects of this Genius Act, which is just incredible, is that they put in there a provision that said that the banks can't pass on the interest rate from the treasuries to their customers. So why would they do that? They would do that to incentivize the banks to use these CBDCs, to be buying these treasuries and have them a nice big fat margin for it, so they don't have to pass on that interest rate to them. So I don't see the incentive there for the banks. The banks are there to make money. They're not. At this point, we're not a socialized country. So let's hope that we continue on the path of freedom.
Let's certainly hope for that. And I will cautiously share your optimism. I want to bring it back to Tether, which brings us back to gold and Bitcoin. And we know that Tether, as you just discussed, is the world's biggest stablecoin issuer. And Tether is actively investing in gold. It's expanding across the entire gold supply chain, from mining to refining to trading to royalties. It's taken a 38% stake in a gold company, Elemental Altus. It also holds $9 billion worth of physical gold stored in a vault in Zurich. Those partly back Tether Gold, which is its gold-pegged stablecoin. But it's in talks with mining and investment groups about deploying capital across gold projects. It's also, again, buying Bitcoin, right? Tether's CEO posted on X that Bitcoin, gold, and land are the hedge against incoming darker times. So again, it brings us back to that debasement trade, to gold and Bitcoin. I mean, what does it say that the biggest issuer of stablecoins, the one that is being, effectively buying U.S. treasuries, is taking its money and buying gold and Bitcoin? Yeah,
I mean, it's a pretty darn good argument for the debasement trade, is that you've got one of the largest players in U.S. treasuries is taking its profits. And, Tether has a few hundred people that works at it, and they're making billions of dollars a year. It's one of the most profitable per capita company out there. And they want to protect that capital. So they're investing it widely. They're in part of that CEP 21 that we talked about, the company that is a Bitcoin treasury company, and they are buying Bitcoin, they are buying gold. That doesn't surprise me at all. It's a resounding argument that one of the largest players in all of U.S. treasuries is turning around and plowing their money to protect it in the debasement trade. not a shock to me at all, and should not be a surprise to anybody. They're taking it to a different level. They have quite a bit larger percentage of holdings than probably your 5, 10, 15%. But that's it's definitely something that you should take note of. If you have not been listening to all of this until today, you should take notice of these things.
So, James, as we start to wrap up here, when you zoom out, what does the global monetary landscape look like to you in 10 years' time?
Well, in 10 years' time, like I said, the U.S. Treasury is going to have $80 trillion of debt, and they're not going to be the only ones. You're going to have you're going to continue to have an explosion of liquidity. I've got a partner, Larry Lepard, who believes that we're getting close to the point where we have an implosion of the fiat system. I don't think we're there yet. He and I agree on the ultimate outcome, but I probably I'm longer on the timeline. And what he talks about is the big print, and the big print is where you have a collapse of the system, where the central banks have to print so much money that it causes an explosion in the asset prices. And so just to try to keep it all going. And do I think that we're going to have that? Yeah, I do. How big that is up to debate. The last major event we had with COVID and lockdowns, we printed $5 trillion. We'll have a multiple of that next time. It's going to be more like 10, 15, 20 trillion dollars. And they'll just print it. They'll print to oblivion, and you have to own assets to protect yourself. So that's what I see in the future. I see a wildly, unfortunately, and this is where I talk to people every single day to help them understand the debasement of their currency, how they're being stolen from stealthily every single day by inflation, how goods prices are going to continue to go up, how houses, how gold, stocks, Bitcoin, they're all going to continue to go up in value. But the reality is the dollar and whatever other currency you are based in is going down against it. That's all that's happening. And there's more of them chasing after the same finite number of assets. And so you're going to have continuation of this. You've got what's happening here is you've got a separation of wealth of the top tier of the top 1 to 10% of demographic who own assets in the bottom 50%. It's only going to get worse, and it really is. It's not okay. All I could say is protect yourself, own these things, and be aware. Just stay in them long term, and just shake off the volatility of these things, because the printing won't stop.
And nothing we heard from Fed Powell today would make us think otherwise, right? As we're cutting rates and starting quantitative tightening. James, I'm curious, when you say hard assets, does that also include equity markets? Because some people would say that we're going to continue to see equity markets rise as a hedge against inflation, as a different kind of hedge against debasement. What are your thoughts there?
Yeah, I mean, of course, owning stocks are they have historically protected you against inflation, meaning that they will go up in value as the expansion of the money supply and liquidity occurs. But I don't call them hard assets. They're different. I mean, they have management risk, execution risk. They've got individual business risks. They've got different risks in their regions, geopolitical regions, or in their sectors. They've got cyclical risk. It's really it depends on individual stocks, how strong they are in different periods of time. Then they're typically not a good hedge against some sort of catastrophic event, like gold has been. We did see Bitcoin as a great hedge against the possible catastrophic event of the lockup of our regional banks back a couple of years ago, when Silicon Valley Bank, when that imploded. We saw Bitcoin rally by 20-30% because people were worried about their dollars just evaporating, like we saw in Greece back in the Great Financial Crisis. So all that said is, Yeah, being exposed to equities is, if you're a young person, then that's part of your portfolio. It's different for me and in where I am and what I'm involved in, but I've been invested in equities my whole life, and that's just part of your portfolio. If you look at the different the different assets that you can own of all these things, I would say the one thing that you probably don't want to own long term is bonds. You don't want to own long-term bonds if you know that we're going to continue to debase our currency and you're going to get a negative real rate of return over the course of time. Everything else, though, art and collectibles, not very liquid, but they rise in value as the fiat currency depreciates. Same thing with stocks, same thing with gold, same thing with Bitcoin, same thing with real estate.
So, final thoughts. What is your highest point of conviction right now?
My highest point of conviction is that the math of the deficits and the expansion of debt and the need for expansion of liquidity the math is what it is. You're not going to be able to change that. It's going to continue, and we're going to continue to see it accelerate for the next 10 to 20 years.
James, where can people find you? Where can they learn more about you? How can they subscribe to The Informationist?
Yeah, so The Informationist is it's just www, obviously, jameslavish.com, and it's on Substack. There's a free version and a paid version. The free version comes out once a month. And I just, like you said, I simplify one complex kind of thing that's going on in the markets for people, and then of course if you're a qualified investor or an accredited investor and you're interested in Bitcoin, you can find us at bitcoinopportunity.fund. Just send us your info. We're happy to jump on the phone with you and see if it's something that would be appropriate for you and your portfolio. So,
all right, James, as always, a pleasure speaking with you. Thank you so much for joining us today.
Well, thank you for having me, Michelle. It's always good talking to you. I look forward to the next time.
Absolutely. And a big thank you, of course, to all of our viewers. Make sure to subscribe if you haven't already and hit that notification bell so you know when the next video is out. As you can see, I read your comments, so I'm expecting a lot of pushback on the Bitcoin conversation here today, but that doesn't mean that we shouldn't have these conversations. We aim to inform you, to make sure that you have the knowledge and information at hand to make your own decisions that protect your wealth and your sovereignty. So as always, feel free to praise, whine, or just opine. From me, Michelle Makori, and the rest of the team, we'll see you next time. Until then, stay sovereign.
This is The Real Story with Michelle Makori.